Hey, it's perfect timing. I'm glad you came in here because I've got a really important closing to do on this building across the street. And I wanted to show everybody this thing we do called financing yourself to wealth using these policies. So let's go take a look and I'll show you how this works, why we do it, and why it's so cool. All right, so this is about 2,000 square feet. The plan is to do some demo in here, put in a nice conference room, etc. Some offices back there, and you can come on back, take a look. There's lots of offices already here. We're probably going to reconfigure some of this and have an area back here for some of our other employees to work. And it's a beautiful location right here across the street from our past office. And so anyway, we're closing on it this month. And what I wanted to show you is how we use financing yourself to wealth with a life insurance policy to pay for the down payment. We're financing the rest of it with the SBA loan, which makes you want to like pull your hair out times 10. The nice thing about this is by using our insurance policies, we can actually compound our growth faster. In addition to get the benefit of getting the real estate, our money continues to grow as it's never been touched. So the key is building up your cash value. And so now what I need to do, after I showed you kind of what we're doing here, I need to go get a policy loan. And so all we got to do is go log into my account, request a policy loan. They'll have a check here within a couple of days that we can use for the down payment on this baby. So let's go take a look at that process. And then I'll get into the nitty-gritty numbers of how this whole thing works to finance yourself. So instead of having to pull this out of your bank account, or instead of pulling it out of other potential investments, you can use your life insurance policy to do this whole thing and get continuous compounding. So let's take a look. Okay, so we took a look at the building that we're closing on this month. Now I want to go ahead and request a policy loan from my policy. I have several different life insurance policies, but I've got some cash value left in this one that I know is accessible. So all you have to do is go log in. As you can see here, I'm on Lafayette Life's website. This is a whole life policy. I have a couple of index universal life policies as well, but there's different reasons to have each different policy. So you log in, and then you just basically go and see how much available cash value you have to do a policy loan. And you don't want to take out loans to go waste the money and spend it on frivolous things. But if you're using it and you know what you're doing with it, then this is exactly what we typically do. So you can see here, net cash surrender value is $28,000, and typically you can get a loan of up to maybe 90% of that. So I'm going to request somewhere around $25,000, $27,000, and all you have to do is click request a policy loan. They've got this little download here that pops up, and so let me just print this out real quick and fill it out. There's really only two fields that I got to fill out: my name, policy number, and then how much loan I want, and then sign it, email it into them, and they're going to mail me a check. So here you see here we printed it out. It's got my policy number on it, name, how much I want, $27,000, and just check the box and mail me a check. Then I sign it, and I'm going to email it back to them, and I'll have a check in my mailbox within a couple of days. So you can see here I didn't have to qualify for finances. I didn't have to prove that I have a job. I didn't have to get a credit check. I didn't have to talk to anybody, answer any questions. It's like, this is my money, send it to me, and I'm going to use it to do an investment. So it's that simple, really, to get the money out of these policies. But while I'm using this money for a real estate investment, my money continues to compound as if it's never been touched, because I'm not actually doing a withdrawal, I'm doing a loan. And so let me show you the power of this real quickly on the whiteboard here in my office as to why you may want to consider using this style of financing in your own business, in your own real estate investments, other investments that you have, or simply just to purchase large purchases in your life, like cars or even trips or home remodeling projects. It's really exciting. I love this concept, so I want to share it with you right now. Okay, so we saw the building we're buying, we saw the policy loan I'm requesting. Now let's talk about why. Why would we use this type of vehicle instead of just paying cash? And there's a couple of reasons, and I'm going to give you a couple of different examples. A car loan example, a real estate rental property like we just looked at, and also hard money lending or private lending contracts. that we'll talk about in a second. But the first thing to recognize when you're looking at this is that you finance everything you buy. Okay, so you finance everything. And once you realize this, and I'm going to have to excuse myself already. My handwriting is not great, especially when I'm in a hurry and on a whiteboard, and my spelling's not great either. And so I think you'll get the point. We finance everything we buy. There's really three ways to finance everything. There's cash. And when you think about cash, well, how is that financing? It's the opportunity cost that you're losing by purchasing something where that cash could have gone to work for you and earned some level of interest elsewhere. Right? So it's an opportunity cost. You're losing out on being able to earn 10 or 12 or 15% in another investment in lieu of buying that car today. Okay, so that's if you pay cash for something, let's just assume it's a car. You're going to lose out on opportunity cost. The second option is credit, right? And that we all know what that looks like. There is all kinds of credit opportunities out there buying a car. Sometimes you can get 0% interest, and that's always a good thing. That way you're not losing out by paying cash, but you're not paying interest either. And then the third way is financing yourself to wealth using the product that I'm going to talk about today. And so cash credit, typically with credit you're going to pay interest and you're going to lose money that way. Cash, you're losing opportunity cost. Financing yourself, we're going to try to mitigate the costs of those losing out on those opportunity costs as much as possible. Now, in America, interest is one of the biggest expenses that Americans have. In fact, in a book written by Nelson Nash, he estimates that the after-tax amount of interest we pay is 34.5% on average. So most of us are going to pay, 30, 40, maybe even 50% taxes. And then after that, another 34.5% is going straight to interest. All right, so that's a lot of money. That's a big chunk of our disposable income going down the drain to interest. A lot of that is in the form of mortgages and that kind of thing, consumer debt, credit cards and car loans, that kind of thing. And so we know that the savings rate in America is usually somewhere between 0 and 5% on average as a country. Right? Sometimes it's negative, and obviously there are a lot of people that save much more than that. You may be one of those. But I just want to run you through the concept of the misnomer, the bad information that's out there about the reality of building wealth and when it comes to interest rates and trying to really grow your wealth. There's an easier way to do it than just trying to get a good rate of return on your money. And so let's just say somebody makes $100K and they say 5%. All right, so we got $5,000. Now that $5,000, we're going to take that and we're going to try to turn that into our retirement because this is our retirement savings. And so you may be able to get fairly easily a 5%, CD or something like that during normal economic times. That may be more difficult to come by today. But what do people do because they're not happy with 5%? We risk our money. We invest it in the market. We put it in mutual funds. We do these risky type endeavors to try to get that to a higher level. And so let's say we're able to do so successfully and we get that up 3% to 8%. Wow. So what's the difference between these two? It's $150. All right? So instead of getting 5%, we got 8%. We sweat, we crunch numbers, we look at the ups and downs of the market, all of the ticker symbols and all that stuff. We put all this time and effort in as Americans trying to grow our portfolio, and we move the needle a little bit. Now, what would happen if instead of only saving 5% and watching 34.5% go down the drain in interest, we were able to recapture just 5% more. And instead of this going to banks and lenders, credit card companies, this was going into your pocket instead, so your savings. Now, all of a sudden, we're making some real progress. Instead of growing our money by, 5% of 5,000 is going to be what, around $250? 8% is going to be around $500, $400 or $500. Okay, and so, this is our growth on our money. So we're looking at $200 to $400, or we can add an extra $5,000 just by doubling the savings rate to 10%. And then we start with $10,000, and we get this same 5%, That's an extra 500 bucks, and we're at 10,500. This is how to really accelerate your wealth growth, is to stop losing your money down the toilet bowl of interest and instead put it back in your own pocket. And that's what financing yourself to wealth allows you to do. Okay, so let's talk about this in a scenario like a car loan. Let's take a $30,000 car loan, all right, and say we're going to pay 7%. Obviously, that's high right now, but that's common during later different parts of the economy, just depending on the time frame. But we'll just say 7%, and we're going to finance that thing for 5 years. The payment on that is basically $594 a month. Now, this is interesting because we're paying 7% on this car loan, right? Well, you times this out by 5 years or 60 months, and what do you get? Do the math. You're not going to get 7% interest. No, you're going to end up paying $35,640. And if you take that, so you paid $5,640 in interest. You take that, divide it by 30,000, get out your calculator, your iPhone, crank that out, and tell me what you get. If you did the math right, you're going to get 18.8% interest. That's how much you just paid on that $30,000 car loan that you thought was 7%. How is that possible? Well, the 7% is APR, annual percentage rate. It's based on the amount of principal existing on that loan year over year over year until it's paid off. And so it's not the interest rate that matters. It's the volume or the quantity of interest that you're paying, which right here is $5,600 over the course of 5 years on this car loan. Now, what happens if you put a house into this equation? This isn't 18%, this is 80%. And you can see now why 34.5% of your after-tax money is going down the drain to interest. It's because of the way the interest world works. I mean, this is absolutely generated to profit the banks and lenders. Okay, so now that we see that, is there an alternative? And the answer is yes, there is. Let's look at financing yourself to wealth, because this again is using credit. What if you were just to pay cash? Well, that's another example, but what I will show you is financing yourself to wealth. Let's say you bought that same $30,000 car, but instead of paying the bank 7%, you pay yourself 7% instead, because you have built up cash value in a IUL, or what we call an Index Universal Life Policy. So we're talking about using a life insurance contract to build up cash value, access that money, and use it as your financing mechanism. And so you borrow that money away, you pay yourself back at the same exact rate. 5 years, $594 a month, and at the end of the day, you've paid back in the exact same amount of money. Now, here's where it gets interesting. After 5 years, let's say you want a new car and you want to sell this thing. A $30,000 car, 5-6 years later, what's it worth? Let's just say we can get almost half of our value out. That may be high, but let's say we sell for $12,000. So after 5 years, we have no car because we've sold it, but we got $12,000 to go towards our next car. So that financing cost us, that car and the financing together cost us $23,000 down the drain, and we've got $12,000 left to show for it. Now over here, because these payments are going back into your own policy, you are working within your own financing system. These payments are going to a bank, and they're out the door, and it's gone. But these are staying within your own system. And so at the end of the day, this $35,000 is actually back in your own pocket. It's like taking money out of one pocket, put it in the other. And so you've got $35,640. And let's say you go to sell that car for $12,000. Now you've got $47,000 back into your own policy that can go towards your nest egg, towards your next car, and will be there to continue growing and compounding. So which one of these scenarios looks best? $12,000 with $23,000 down the drain to a bank, or $47,000? Now let's talk about this interest for a second, because this is important. In an IUL, if you use the proper IUL, you are going to be able to use this $30,000 and it will continue to grow as if it's never been touched. What does that mean? It means that when you take a loan against your policy, you don't do a withdrawal. You're not taking money out of the policy. So in an IUL, you can get potentially 0 to 13% interest credited on your cash value. The average is usually around 7%. Historically, it's between 7 and 8%. And so effectively, your interest costs are wiped out, and all of your money is going back towards principal because you're able to offset the cost of the interest loan, which is not 7%. Usually it's 4-ish% from the insurance companies. And you're still growing that money as if it's never been touched. And so that's kind of a hard concept for people to understand sometimes, so let me make sure that's clear. If I go take a $30,000 loan from the insurance company, I'm not withdrawing my money from my policy. My policy is going to continue to grow as if it had $30,000 in it, because it does. This $30,000 is coming from the general fund of the insurance company, and they're going to charge us interest on that, maybe 4 or 5%. And you still have the ability to earn 0 to 13%, averaging about 7. So you actually can make some money with some positive arbitrage. But that's not really, that's not what we're going for. What we're going for is $47,000 back in the policy instead of $12,000 to go towards our next car. Now let's talk about how this works with rental real estate, because this is a really cool feature. Again, the point here is, what is our money doing when we're talking about using it to grow our wealth? Where is it sitting, and what is it doing while it's sitting there waiting to be invested or waiting to go to work for us? You may have money sitting in a bank account right now that's just really not doing anything, but you want it to be safe, you want it to be liquid, and you feel good about having that money sitting there. I always like to see my bank account balances and just know, yeah, if something happens, I'm okay, right? And so a lot of us feel that way. But if you're putting your money to work for you, where is that money going to go to work where you can actually get a good rate of return, and while it's not working for you, it's still earning you some money? If it's in the bank account, we know what that's doing. Because right here, you can say we got a bank that's paying you 0% interest. You put this money to work, you put it into a rental property, and then the cash flow comes out, and it goes back into the bank and sits there and waits for the next deal. This is kind of how the cash flow model works. And so we store it up here until we have enough to go towards the next deal, right? That's kind of how this works. All right, so let's look at the building that we're purchasing. I have a real estate company, and I have an operating company that generates profits. And so my real estate company is going to purchase this building and lease it to my operating company, Wealth Education Group. And so real estate, so we'll just call it Brett's Real Estate Company. That's not what it's called, by the way, but it's kind of a catchy title. Real Estate Company is going to buy this building for $260,000. We're going to put 20% down, which is about $52,000. And as you saw, I went and got half of that down payment from my life insurance policy. My partner's going to do the other half. And so this money has been sitting there earning interest while we've been waiting for this deal to come along. But let's just take a look at how the numbers come out. The loan on this, the balance here, and I told you before, we're doing an SBA loan. Like, it's the worst paperwork nightmare you can possibly imagine. And at 5% over 25 years, they give you good rates though. The payment is somewhere around $1,200 a month. So very little for a commercial property. We're going to lease it to our operating company for $2,500 a month. So our cash flow is $1,300 a month on that property. Okay, over the course of a year, that's about $15,800, I think, is what I figured earlier. Maybe $15,600. Okay, so this is cash flow. So when you divide this into our cash down, you end up with about a 30% cash on cash return, which is really high for most real estate deals, but that really doesn't matter. What matters is, what are we doing with this $1,300 a month, right? Well, because I can take this cash flow, I can put it back in the bank at 0%, or I can take it, and instead of using a bank, I can put it back in my policy. That's 7% average, right? And so now, while this money is sitting there, it's compounding at 7% and waiting for my next deal to come along. And so I've got a vehicle now to perpetuate and grow my real estate portfolio faster. And here's how that works. So let's say that, I'm just going to take the full amount because it's easier that way. So I've got $50,000 I pull out, put it into a real estate project, and now I've got $15,000 coming back. Well, because this is continuing to grow as if it's never been touched, I'm earning interest here, potentially, as long as the market goes up. But now I'm restocking my portfolio down payment with payments from this real estate. So in year one, $15,000. In year two, $15,000. Now I'm up to $30K. In year three, now I'm up to $45,000. And I can go do another real estate deal, all while this money has been growing at, say, 7% on average. So it's not like 7% is enough to get really excited about if you're into real estate. But what it does do is I've got my money sitting there waiting to do my next project, and it's not getting zero in a bank account, right? So it is at least getting me something. And when you think about it this way, if I'm paying 4.5% loan, I'm positive arbitraging 2.5% on the same money twice. So where I'm getting a 30% cash on cash, I'm getting another 2.5% positive arbitrage in this example. So I'm really getting 32.5%. And an extra 2.5% compounded over time makes a huge difference. And so this is how it works with cash flow real estate. Not only is it great because it keeps the money working for you, and it's a self-perpetuating program to build up for that next property, next property, next property. It also gives you extra compounding on that money through the variable arbitrage that you can experience. Now, we use this kind of process for private lending, where we'll take a loan out of our policy and we'll do a private loan to a real estate investor who's fixing and flipping properties, for example. Usually we make about 15% on that deal, but those deals turn quickly. And so they're back into the policy within 6 months. Well, I don't always know when the next deal is going to come along. I may take out 50 grand, do a deal, it comes back, and 2 months later, I don't have a deal for 2 months. Well, where's my money sitting? What's it doing during that time? Here, I know that it's always at work for me. And so at least I'm getting something out of it. And it's nice to have it separated from my bank account, because we all know what happens to money in a bank account. It's the toilet bowl of expenses, and it gets spent. And so this is how financing yourself to wealth really works. It works as a self-contained system to perpetuate your next deal, your next project. It also allows you to finance cars and other projects and other purchases that you want to make in your own lives. And so over the course of, say, 5 cars, when you buy a car, you can save up and buy a car. And after 5 years, you're back to zero in your bank account. You save up, you buy a car, and it goes like this. Or with financing yourself to wealth, you save up, you buy a car, but you don't go all the way back down to zero because your money is still growing, even though you've used it. And so it slowly works its way up to where you're continuing to compound and grow your money even though you're using it for other purchases. So this is actually one of the concepts that got me most excited about the life insurance policies. And I purchased one of these long before I ever thought to promote them or tell anybody else about them. I personally got tired of losing my money in Wall Street and said there's got to be a better way. And so this is one of the solutions that I found. And when you combine it with other strategies, like financing, like cash flow real estate or private lending, it can be an extremely powerful concept, and we use it all the time. It's been a great thing for us, and hopefully it will be for you too. So if you want to learn more about how to do this, if you've got some ideas of projects you'd like to do, or just simply you want to get it into a place where it's not going to be lost in the market, then we'll always have our trained professionals available to go through this kind of a scenario with you, talk you through the ins and outs, explain all the details. Obviously, there's some intricacies here. There's probably some questions that you have after watching this. How does that all work? Obviously, I haven't explained it all in detail here. but that's what we have our trained professionals do for us. And so you can talk to them, see if a plan like this makes sense for you. If it does, great. You're going to be able to use this thing as a great financial vehicle for you and your family for many, many, many years. And don't forget, this has a death benefit associated with it. It's a life insurance policy. So if you have a bunch of rental real estate and all of a sudden something happens to you, the death benefit can come in, and instead of somebody having to sell off all those properties because you've got mortgages on them all, you can pay off the properties and keep them and have that cash flow for your wife or your spouse or your family. And so there's other benefits here besides just this financing topic, as we've talked about in previous videos. But hopefully that gives you a little bit of a picture of all the different kind of Swiss Army knife ways you can use this tool. And if you have any questions, just request a consultation here on the page. Be happy to talk to you for 10-15 minutes and see if this is something that you can use to improve your own financial situation and compound your wealth a little bit faster.